Okay, so now we want to get into more of the nitty gritty. So some of these things may not apply to everybody, but there's several chapters to your book where it does get into the nitty gritty. We want to cover a couple of these, and I brought with me my expert who's on our team, Heidi Butler, works in financial operations here, talks to a lot of investors, and right now we're preparing our K-1's.
Exciting.
That are going to be sent out here soon. So wanted to have Heidi join. And one of the big questions that we've got is around U.B.I.T, U-B-I-T. And I'll ask this question. So this is from Jeremy. So Jeremy, thank you for asking this question. We got the expert here to answer it. So he says, I was considering making an investment with my solo 401k into venture on 12th. So this is one of our individual projects. I was reviewing the material on your website, and it mentioned U.B.I.T tax. I have consulted with my tax professional, and they informed me that UDFI, a form of U.B.I.T, is exempt with 401ks. Is there anything else about the way these deals are structured that would trigger U.B.I.T other than the leverage, such as operational business expenses, etc.? Please let me know. I really want to invest, but not if the deal is going to trigger U.B.I.T. Again, I am investing with a solo 401k, not a Roth IRA. So when we got this, we're like, this is a little out of our wheelhouse. We're real estate investment people, but we need to send this over to Matt. So I wanted to wait.
Thank goodness it's given me a job. If this was too easy, I wouldn't have a job, and nobody would buy the book. Great news for Jeremy.
Yep.
Great news for Jeremy is no UDFI. Which is a form of U.B.I.T that you get with leveraged real estate projects like you would have on this deal. So solo 401ks are exempt from UDFI on leveraged real estate. It's a very specific exemption. A lot of people will say solo 401ks are exempt from U.B.I.T. No, they're not. They're exempt from a very specific type, which is this type in your situation. So the good news is UDFI, which is a tax that applies to an IRA mostly when that's leveraged with debt to purchase real estate. It's just a weird tax that applies. Solo Ks just have an exemption for it. Really, the 401k industry lobbied for it, and they got an exemption so that 401ks wouldn't have to worry about it, which will help even someone with a solo K.
That's the best answer I was looking for.
Yeah. So green light, Jeremy. You're in luck.
Now, if it's a Roth or a traditional IRA, and he's looking to invest in one of our projects do have debt. Typically 50 to 60% of the capital is debt.
Yeah.
What's kind of the way to think about that if you are investing in one of our projects and how that could affect U.B.I.T?
So IRAs, whether it's traditional, Roth, SEP, you can self-direct a health savings account. These accounts are all subject to this UDFI. And so people need to know that. But the best way to explain it is an example. Okay. Let's say you bought a property for $100,000. Okay. I know you guys aren't, but
no, this is a great example.
I can do the math on it. All right.
Yeah.
So you can understand the principle. And let's say you got $50,000 in debt and you got $50,000 was from the cash. Okay. Now, if this was an IRA owning at 100%, let's just say the IRA was doing this 100%. It works the same if you got a piece of something too. So IRA owns at 100%. Let's say that the property sells a year later and has a $20,000 gain. Let's say there was $10,000 in expenses in the sale. At the end of the day, $10,000 is taxable. Okay. Well, $10,000 is coming to the IRA. Well, the IRS looks at that and says, well, half of that money was debt. It wasn't retirement account money. You were able to buy more assets with debt. So half of that money is going to be subject to this UDFI tax. So half of the $10,000 of gain after all your expenses, $5,000 would be subject to this tax. Now, the tax on the sale of an asset, you get capital gains rate for this UDFI tax. So I've got $5,000 that would be subject to capital gains tax of max rate of 20%,
right?
Which would be, what is that? $1,000 is what you'd end up paying. So the retirement account made 10. In this example, it had to pay $1,000 in tax, and it kept the other 9. So that's how UDFI works. It's really just the more debt you have, obviously, on a project, the more goes into this ratio.
And does that matter if it's a Roth IRA or a traditional IRA?
Same tax. Yep.
Same.
Yeah.
But the exception for Jeremy is that it's the 401k
Yep, exactly.
that it doesn't impact him.